Welcome to The Explainer. Today, we're doing a deep dive into the absolute building blocks of business finance. We're going to take a granular look at how an organization handles the preparation of different types of budgets, starting from the specific mechanics of functional budgets all the way up to rolling them into one unified master budget. It's like a giant puzzle, and we're going to see exactly how all the pieces fit together. Okay, let's just ground ourselves right off the bat with a quick definition. So, what actually is a budget? Well, it's basically your principal projection tool for estimating future costs and revenues. It's an absolutely essential aspect of management accounting and financial control. This is how a business decides where it's going and, more importantly, measures if it's actually getting there. Here's our roadmap for this explainer. We're going to meet the functional budgets, track the flow from sales to production, dive into cash and capital planning, build out the master budget itself, and finally, look at reviewing and revising the whole thing. Section 1. Meet the functional budgets.
Think of a business like a massive engine, right? With all these interconnected gears. You literally cannot figure out your material or direct labor needs until you know exactly how much you're producing. And, well, you don't know your production quantity until you forecast your sales. It's a strict cascade. The preparation of different types of budgets means one forecast directly feeds the next, making sure the entire organization is marching to the exact same beat.
Section 2. From sales to production. Now, here's the crucial point. The sales budget? That is the engine of the entire business. It's the keystone. The sales manager takes the reins here, analyzing past behavior, looking at market potential, management policies, and the available finance. Every single other budget we're looking at today is built entirely on the assumption that these initial sales figures are right on the money. What's super interesting here is seeing how a basic market study translates into hard, real-world numbers. Take Sri Ramu, for example, manufacturing two toys, Raja and Rani. A study showed the Rani toy was a bit overpriced, while Raja was super popular but actually underpriced. So by tweaking the prices, bumping up Raja and dropping Rani, and then factoring in a heavy ad campaign, the sales manager can precisely project both the unit volume and the expected revenue. That detailed breakdown by product and by territory is exactly what a functional sales budget looks like in the wild. All right, so once those sales are forecasted, we just balance the equation to find our production needs. It's a pretty straightforward formula. What we actually want to sell, plus whatever we want left over in the warehouse as closing stock, minus what we already have on hand as opening stock, equals exactly what we need to produce. This production budget is basically the green light from the purchasing department to go buy materials and for HR to figure out labor hours. Section 3. Cash and capital planning. Now, beyond the obvious direct materials and labor, every business has overheads, right? We generally chop this overheads budget into 3 distinct blocks: manufacturing, administration, and selling and distribution. It's really vital to understand how these behave. Administrative costs, like just running the organization, are mostly unconnected to how much you're actually producing. But selling expenses, things like delivery or advertising, those are going to vary right alongside the sales targets we just talked about in step 1. And then, of course, we have the cash budget. The main objective here is pretty simple, honestly. A firm has to meet its commitments on time, but without just sitting on unnecessarily large idle piles of cash. They figure this out using one of 3 projection methods. If you're tracking things short-term, the receipts and payments method is great for mapping out exact cash inflows and outflows. But for longer-term forecasting, you look at the adjusted profit and loss account method, which you probably know as a cash flow statement. That factors in non-cash stuff like depreciation to give you a true picture of cash availability. Section 4. Building the master budget. So, you might be wondering at this point, how do executives or the board of directors make sense of all these scattered, incredibly detailed functional documents? Are they really sifting through every single material purchase order and labor estimate? Definitely not. And this is where we get the big payoff moment. The preparation of the master budget coordinates all that chaos into one harmonious unit. Roland and William H. Hare actually hit the nail on the head when they described it as a summary of the budget schedules in capsule form. It takes all those functional budgets we just went through and magically transforms them into a projected profit and loss account and balance sheet for the end of the budget period. Let's look at this snapshot for a glass manufacturing company. You instantly see the big picture here. We can clearly see how direct materials and direct wages combine to form the prime cost. Add in factory overheads, and you get the works cost. Deduct that from your total sales, and boom, there's your gross profit. Once you subtract the administration and selling overheads, you're left with the ultimate bottom line, net profit. This single document gives you the absolute highlights of the entire budget forecast. It's brilliant. Section 5, reviewing and revising budgets. But look, business is incredibly dynamic, right? Reality happens. A completely fixed, static budget, that's going to fail as a measuring tool the second external factors hit. And they always hit. If there's a sudden material price spiral, unexpected inflation, or maybe you just find an error in the original math, you have to do a thorough review of the different budgets. They must be revised. This is exactly why budget reports are so critical. They let you stack up your budgeted figures against actual real-world figures, which allows management to step in and take corrective action using the principle of management by exception. So I want to leave you with a thought to chew on. In a totally dynamic world, a static budget is basically a one-way ticket to serious inaccuracies. How often will your business review and adjust its master plan to actually survive and thrive? Just remember, budgeting is an active, ongoing loop of financial planning. It's for sure not just a one-and-done event you stuff into a drawer. Thanks so much for joining me for this explainer, and keep looking at the big picture.